The game nobody told you existed in 2020. The 12 richest people in America had a combined net worth of $608 billion. By 2026, just 6 years later, that number had grown to $2.7 trillion. Their wealth didn't just grow, it quadrupled in 6 years. Meanwhile, the bottom half of Americans about nearly 165 million people, share less than 3% of the country's total wealth between them. Now here's the question nobody is asking. How? How does wealth grow that fast for that few people in that short a time? Because, I promise you, it is not because they worked 4 times harder. There is a game being played with money, and most people were never taught the rules. This video changes that. Director note, let me start with something that sounds too simple to be true, but it is, and once you see it you cannot unsee it. Most people in the world are playing Game A. They earn money, they spend money, they save whatever's left, usually in a bank account. Maybe they own their home, that's it, that's the whole strategy. The wealthy, specifically the top 1%, are playing Game B, and it has completely different rules. In Game B, you don't just earn money. You use money to buy assets that earn money for you while you sleep. You hold stocks that compound. You own real estate that generates rent. You invest in private businesses before they go public. Your money is never sitting still. It's working. Here is why this matters so much right now. In 2025, the stock market had a strong year, driven largely by investments in artificial intelligence. The wealthy own 87% of all stocks in America. So when the stock market goes up, the wealth gap doesn't just grow, it accelerates. And that is exactly what the data shows. The Federal Reserve confirmed that in late 2025, the top 1% owned 31.7% of all wealth in the United States, the highest concentration ever recorded since the Fed began tracking it in 1989. We are not watching inequality plateau, we are watching it hit an all-time high, and understanding why is the first step to doing something about it. Let me show you exactly how extreme this has become, because when you see it laid out, it's genuinely hard to process. The World Inequality Report 2026, published just this year, found that the bottom 50% of the entire planet earns just 8% of all global income. 8% for half of humanity. Meanwhile, the richest 10% of the world owns 75% of all personal wealth on Earth. Now let's zoom into the United States specifically, because the numbers get even more stark. The top 1% of American households hold around $55 trillion in assets. That is roughly equal to the combined wealth of the bottom 90% of Americans. 1% versus 90%. Same number. And here's the detail that should make you stop and think. Most people in the bottom 90% hold most of their wealth in one place, their home. The Federal Reserve's data shows the bottom 50% of Americans hold over 50% of their assets in real estate, and most of that is just the house they live in. It doesn't generate income, it just sits there. Compare that to the wealthiest households. Research from the Federal Reserve and Vanguard shows that a typical millionaire holds 65% of their wealth in stocks, 25% in bonds, and only 10% in cash. The top 0.1% hold around 70% of their financial wealth in equities alone. So the middle class stores wealth in an asset that grows slowly and generates nothing. The wealthy store wealth in assets that compound, pay dividends, and grow while they sleep. This is not a coincidence. This is not luck. This is a structural difference in how each group thinks about money, and it was being taught in one place and not the other long before any of us were born. The question is, once you know this, what do you actually do about it? The asset game. Exactly how they do it. So let's talk about the actual game. Because once you understand the mechanics, the whole system starts to make sense. And more importantly, you start to see the doors that are open to you. The wealth gap doesn't grow because rich people work harder. It grows because of one concept that almost no school in the world teaches: assets versus liabilities. An asset puts money into your pocket. A liability takes money out of your pocket. A rental property is an asset. It generates income every month. A car is a liability. It costs you money every month. A stock portfolio is an asset. It grows and pays dividends. Credit card debt is a liability. It charges you interest every month. Here is the brutal truth that the data reveals. Most people spend their entire lives accumulating liabilities and calling them assets. They get a car loan. They carry credit card debt. They buy a home. and think it's an investment, but it costs them in mortgage payments, maintenance, and property taxes every single year. The wealthy do the opposite. According to the 2026 High Net Worth Asset Allocation Study, the average high net worth investor holds half their net worth in stocks and over a quarter in private and alternative assets. They are not parking money in savings accounts earning 2%. They're deploying it into assets that generate returns of 8, 10, 12% a year, compounding silently, year after year. And here is where it gets really interesting. Wealthy investors think in 3 dimensions that most people never use. First, passive income. Their money generates income without them having to show up. Dividends, rent, interest from private loans. This is income that doesn't require trading time for money. Second, compound growth. When you reinvest returns, dividends back into stocks, rental income back into more property, your wealth doesn't grow in a straight line. It grows exponentially. A $10,000 investment at 10% annual return is worth $67,000 in 20 years. You didn't work for that $57,000. The asset did. Third, tax efficiency. This is the one that barely anyone talks about. The wealthy structure their assets to minimize what they pay in tax, legally. Capital gains tax rates are lower than income tax rates. Owning assets through the right structures means wealth compounds at a faster rate than it would for someone earning the same amount as a salary. These are not secret strategies. They are not illegal. They are not reserved for people with millions. They are simply the rules of Game B. And nobody gave you the rulebook. Until now. The empowerment. What you can actually do. So here is the part that actually matters, because understanding the problem is step 1. But what do you do with it? I want to be clear about something first. You do not need to be a millionaire to start playing Game B. You need to change what you do with the money you already have, starting with even a small amount. Here is exactly how. Rule 1. Buy assets before you buy luxuries. Every time you get paid, the first question should not be, what do I want to buy? The first question should be, what can I buy that will pay me back? Even $50 a month invested consistently into a low-cost index fund, an S&P 500 ETF for example, is you entering the asset game. You are buying a tiny piece of the 500 largest companies in America. You are putting your money to work. That is Game B, and it compounds. Rule 2. Understand the difference between your home and an investment. Your home is not an investment. It is a place you live, and it costs you money every month. That does not mean you should not own one, but it means you should not count it as your wealth-building strategy. The wealthy own additional properties that generate rent. Or they invest in REITs, which are funds that own real estate and pay you dividends. You can buy into a REIT with as little as the price of a single stock. Rule 3. Make your money work harder than your bank does. The average savings account in 2026 pays somewhere around 2% interest. Inflation is running higher than that. This means your savings account is not saving you. It is slowly losing you money in real terms. Moving even a portion into a high-yield savings account, a government bond fund, or an index ETF changes the trajectory of your money completely. Rule 4. Think in decades, not months. The single most powerful wealth-building tool available to a 20-year-old is time. The wealthy understand compound growth deeply. They think in 10, 20, 30-year horizons. They do not panic sell when markets drop. They buy more. Every billionaire's wealth story involves at minimum one period where the market fell 30% and they did not sell. That discipline is free. It costs nothing, and it is worth everything. Rule 5. Build financial literacy like a skill. Here is a fact that will not surprise you. The wealthy spend significant time and money on financial education, not because they enjoy it, but because they understand that knowing how money works is the most valuable skill a person can own. Every hour you invest in understanding assets, tax, investing, and compounding is an hour that will pay you back for the rest of your life. The wealth gap is real, the numbers are staggering, but this is the part that the doom and gloom coverage always leaves out. The rules are learnable, the game is joinable, and the earlier you start, the more time compounds in your favor. You are watching this video. That is already step 1. We started this video with a number. $608 billion, growing to $2.7 trillion in 6 years. And at first, that number just feels unfair. Maybe it still does. but I hope what you're leaving with now is something more useful than anger. Because the wealth gap is not a wall you are locked out of. It is a game with rules. Rules that were kept from most people not through malice, but through a system that simply never taught them. Thanks for watching. If you found this helpful, subscribe and check the links below for more resources.